Hi, this is Randy Finney with the right side of the chart, and today is Monday, May 7th, 2018. This is a market wrap. Just take a quick look at the QQQ and SPY, and I'll keep this one pretty short. All right, these charts were put out this morning, right after about a little, almost half an hour before the market. Oh, I'm sorry, about half an hour after the market opened, just to see how things were going. I did have a little typo in there, but it pretty much, said that QQQ is approaching the 165.85 resistance level. Obviously, I meant to say the 166.85. We were already at 166.42. So just a quick typo there I wanted to correct. And that was the target I was looking for with a reversal. Pretty good, well-defined level. You can see a previous reaction high, a gap. Now, what stood out to me on the chart, as you can see from all the yellow circles here, since we've been in this trading range for the last few months, you can see there's only a few instances where we've been overbought on the 60-minute RSI, and they're all circled right here in yellow. And each of those readings, resulted in either, in this case, it wasn't so much of a pullback, but it was a sideways consult. There was a pullback. It was pretty minor, not really enough meat to trade, not enough meat on the bone. And then that ended with a divergent high right there, a correction, and another larger divergent high. So, point being, in every single instance since we've been in this trading range, and that's the key now. If this market's headed on to new highs, then we can become a lot more overbought than we are, and it may start to ignore some of these signals. But for the time being, we're smack in the middle of this trading range, and so therefore you have to look at these, how to trade the market when we're in this range, and you have to assume until and unless proven otherwise that we're still in this range. So therefore, there it is. You can see all the circles. Now, in addition to being overbought, what you look for as well are bearish crossovers on the PPO. And right there, you can see we had one that came right after the overbought reading right here. So if you really, like I always say, overbought in itself is not a buy or sell signal, because overbought can and often does become more overbought. But where you usually can have some predictive value is when the RSI crosses above the 70 level. For those of you not familiar with what I'm talking about, if you're new to technical analysis, on the RSI, the red line, anything 70 or more, that red line is considered overbought, while anything 30 or lower is considered oversold. And so if you're going to have any type of sell signal, my experience has been once you cross back down below that 70 level, and you can see how that lines up almost perfectly with the bearish crossover on the PPO. Actually, I had a MACD line up here. The PPO and MACD are very similar. I'll put a PPO up on the next chart. And so there's what we were looking at this morning. I was looking for a hair more upside to 166.85. And then we'll get to, let's just, while we're on this post from this morning, let's just look at SPY. Same story there. You can see it's pretty simple, yet effective. And without fail, you look at these overbought readings over the last few months, and without fail, again, in every instance, you had a correction off those levels. So will this time be different? It could be, but you're betting against the odds. The last 1, 2, 3, 4, 5, 6, 7 times since we've been in this trading range, these overbought readings were followed by corrections. And again, you want to look for a bearish crossover in the PPO to confirm that. So let's take a look at what happened with the markets today. Those were the levels we were looking at. SPY, I was already on this chart. We are just looking at SPY. We did go up a little bit higher. There's that level. 268.05 stopped cold right around that level. You can see as I zoom in there, almost a perfect kiss of that resistance. And what I was targeting is this previous reaction high. These resistance lines are not arbitrary by any means. You look at a lot of reactions off those levels. Again, you can just go to the left of the chart. You see gaps. Those are like magnets as well, act as support and resistance. So there it is. Now, of course, we were overbought, near-term overbought, especially extended from that big run on Friday. But if you look at the same factors on the chart, you can see here the PPO is starting to roll over. Here's the PPO histogram. That just tells you when the PPO crosses. So again, here's that last overbought reading on, let's see when that was. Actually, this is the one I wanted to look at here. I'm looking at what I call a high level bearish PPO cross, when the PPO is up here at high levels in conjunction with overbought. That's what we're looking for. And again, on that previous chart, all those overbought readings were circled. So the last time we were there was on April 18th, and that was right here. From that point, We did get confirmation with the bearish crossover. The SPY fell about 4.5% from that point down to the lows right here, and QQQ actually dropped 6.25, much faster, 6.25%. So try to gauge, what these signals have given us in the past. Okay, here's QQQ, and again, 166.85 was the level I was targeting this morning, which I incorrectly typoed at 165.85. And as you zoom in here, you can see almost to the button. Again, these are pretty well-defined resistance levels. Not only price resistance, by the way, guys. I also put up, for those who follow the site, and it's public content, free content, because this was a broad market coverage. I put up a post showing the Fibonacci retracements. Okay, here we go. This is that post from earlier today. I was using the NASDAQ 100. This post was actually what I was trying to point out is the disparity or the divergences, I should say, between both the NASDAQ 100 and the NASDAQ 100 equal weighted index. The NASDAQ 100 is a very top heavy index, meaning the top components, the top five stocks, and as you go down the line, the weightings are lower. Even the top 10 stocks make up the bulk of the returns on the NASDAQ 100, Apple being the largest component. And so therefore, we've seen a rally, and this is proof. I mean, I've watched it every day. I keep tons of dozens and dozens of streaming charts. I follow all these components, and I know off this rally those just a handful of names, those FAAMG stocks, FAME stocks, Facebook, Amazon, Alphabet, Microsoft, and Amazon. Did I say Amazon? Either way, those big five, the top five components. And then you have Intel rounding out number six and some other ones. And they have done most of the heavy lifting in recent days. And that's not, if that trend continues, that's not a good sign. It just shows that just a handful of stocks are lifting the market or doing most of the heavy lifting. Again, I'm talking in generalities here. I'm not saying that those are the only five stocks that have risen in the last week or so. But when you look at the underperformance, what I pointed out, and I'll show on the next chart here, that the NASDAQ 100, again, this was earlier today, this was around noon, the NASDAQ 100 had almost reached that key 61.8. And let me say this, I love when I can align multiple resistance points. That is not by coincidence. That's that same level I was just showing you on QQQ. Of course, this is the NASDAQ 100 index, so the price points are going to be different. The Q's track, but you can see that reaction high. You can see the gap. You can see the reaction right there. Is it mere coincidence that that 61.8 fib lines up exactly at that resistance level? No. Sometimes you don't always get it so perfect, but very often you do. So when you have key Fibonacci resistance levels or retracement levels, which some traders use exclusively in their trading, I like to incorporate it, and I just want to point out that's a pretty significant resistance zone. So if you're bullish or looking for more upside, obviously, definitive and impulsive break and close above that would be bullish. Otherwise, watch for a failure here. We're at resistance. I just showed you, all the RSI, the PPO crossovers, everything else. That if we see more downside tomorrow, especially if we take out Friday's lows, that entire candlestick, that's what I'm looking for. That would be extremely bearish if we reverse Friday's gains sometime this week. So we'll see what happens. And by the way, if I wasn't clear, and again, it's on the site, this retracement here, it's from the March 13th high. That's when the NASDAQ 100 topped down to the lows, if you're not familiar with fib retracements. In fact, you can see the line right here. This is the fib line, so it marks that high right here. It starts there and goes down to the lows. So there it is. That's where we failed today. And again, as I showed you, the NDXE had only partially retraced what the NASDAQ 100 did. And this is the NDXE, the equal weighted NASDAQ 100, where they apply, an equal weighting to all of what roughly 100 components in there. And you can see, whereas the NDX, and it did go on to hit that 61.8 fib retracement key level, you tell me this is pure coincidence. These are the primary fib retracement levels I usually watch, and most traders look for during retracements. If it's just a kickback rally within a larger trend, you usually stop at any one of these, the 38.2, 50%, or the 61.8%. And so at the same time today, we had the NDXE, the equal weighted index, fail at that 38.2 Fibonacci retracement level, again off its same move from the March 13th highs down into the April 2nd lows. and that's where we had the Nasdaq 100 stop. Like I said, the S&P 500, I mentioned this in the post, wasn't the divergence wasn't nearly as bad between the S&P 500 and the S&P 500 equal weighted index. Part of that is because you don't have such a large weighting. If you pull, and you can do this, just Google SPY weightings, QQQ weightings, and you'll get a list of how they're weighted. And yes, the top components of SPY do have a heavier weighting, but not nearly as much. It's not nearly as overweighted with its top components as is the Nasdaq 100. In addition, it has roughly 500 stocks in it. But with that being said, this is additional evidence. You can see that the S&P 500 had retraced, and I did this one off this most recent drop here from looks like April 18th down into the lows in early May last week, and there's a rally. There's where the S&P 500 equal weighted was. So we'll go ahead and move on. You can see here it is. This is the S&P 500 equal weighted index. Okay, and despite the recent rally, especially Friday's fairly relatively strong rally, and again, I pointed out at the time the move that we made on Friday was absolutely well within the range of intraday, a lot of intraday price swings. Wasn't even on the larger extent of some of these intraday price swings that we've seen since this volatility kicked off late January. So right now. Uh, Whether you're bull or bear, you can't read too much in any of this price action because the bottom line is we're in the middle of this trading range, and this thing may end any day now. We can break to the upside or downside, or it may continue for a while. But that's it. The market's been moving up and down with these sharp rips and dips, and there's really not a lot that has changed technically. It is important to note we still have the PPO, and that's a great trend indicator. Last time the PPO crossed down, and again I use a signal line, the 9 EMA. Last time that crossed below the zero line was back all the way in 2015. You can see that that white line, the signal line, has remained above the zero line with a lot of successful tests. I talk about this a lot, and it's a pretty good intermediate term trend indicator. And went bearish right here. We had a little flash crash, meltdown in the Qs. We got back above it, but then we fell below. And this was at 2+ year sideways trading range in the market. And again, here we got above and we stayed above it at that point until now. So that's by that one metric alone, that trend says that the intermediate term trend is still bearish. Same story on the SPY. That's a 4-year chart. This is a 2-year chart. We're still below right there, and the lines are flattening out, so you really can't take much away from it other than that signal line. The 9 EMA is still below zero, and again, just like QQQ, we're in a trading range. Sort of takes the form of a triangle pattern here in SPY as well. So there might be a pop if we get to the upside of that, but or if we get to the downside of the triangle as well. But either way, you can see there's some significant reaction highs to be taken out along the way. So really you need to break, above or below this recent trading range. And until then, it's just a lot of noise. If you're an active trader, great. This rally that we had now stemmed from bullish divergences that were pointed out last week in advance of Friday's highs. I think I pointed those out on a Thursday, and those have played out. So at this point, we don't have divergences. Here, I just jump back to the 60-minute chart. This was that divergent low pointed out last week we had on Thursday. You can see the bullish divergence here. And so it's played out, and it's played out for a pretty decent rally, about 3.5% on SPY, probably more than that on QQQ. I'll check in a second. So where do we go from here? Well, if this bearish crossover is confirmed, like I said, we'll have that sell signal that served us well in the past few months, and then we could be looking at more downside here, quite a bit more. If not, my bullish scenario would have us at least back testing some of these levels. You can see I have a support zone here, 265.49. We'll call that 265.50, down to about 264.88 or so. So maybe come in and back test. There's also a potential downtrend line here. I'm not crazy about it. There weren't a lot of reactions on it, but it does line up with that support zone. So that would be your bullish scenario. And of course, we still have to take out 268.05, we'll call it, to move on up to the next level. And then I'm sure there's a big old gap back here to be dealt with. In fact, we were rejected off the bottom of that big gap. I'm referring to back here, and then above that you can see there's quite a bit of resistance overhead. I don't have all the lines here on this chart. You can see there's a gap, the top of a gap. there's another gap right there, some reactions. The bottom of the gap is just below it. You could certainly put a resistance line there. So like I said, the market has a lot of work in front of it, more so to the upside um, than to the downside. If we happen to reverse and take out Friday's lows, that probably opened the door for a move down. Well, it almost certainly open a move to the door to test these lows here at 254.80. But if we start getting down there, my thought is we'll probably start a waterfall type sell-off down through there. So let's just see what happens. And then QQQ, we didn't have the same. I pointed out on the futures some small divergences, bullish divergences, and we took that out. And here's a trend line. Again, if you're looking for pullback targets to go long or levels that if they do not hold to maybe add to or initiate a short position, that would be what I'm looking at. This downtrend line. At the very least, look for back of that downtrend, back test of the downtrend line. We have quite a few reactions off it. It's a little bit better defined than SPY. Not a whole lot, but you can see there's about 4 reactions. We broke out on Friday, which is bullish, and if that breakout sticks, we have a little bit of a gap. That's Friday's highs. We might actually, I think we came in, almost backfilled that, or hit the top of the gap, I should say. Yeah, that's where we reversed on the pullback. So tomorrow, maybe look for a full backfill of that gap. And like I said, see what happens as we come on back down. If we do come on back down, if those 60-minute divergences are confirmed, there's another support level. See what happens. See how how the market acts as these levels are hit. If we smash right through them or have a very minor consolidation, and especially if we come back here and we hit this trend line and we don't have a successful backtest with impulsive buying off of it, things could get ugly. But until then, again, it's noise within the trading range. So if you're a longer term trader or investor, the charts start to get muddled up too. I'm trying to find some attractive swing trade ideas, but when you have this back and forth grind, a lot of the stocks within the market are also seeing what we're seeing here. Again, we go back to the daily chart, and what I'm referring to is just a flattening out of the momentum indicators and prices all over the place. So we just, I think it makes sense to just keep things a little bit light now and let this trading range resolve one way or the other. So that's it. We'll wrap it up here. And if I see anything that I missed, I'll point that out in the comments section under this post. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.